Hi everyone, and welcome to a new episode of Surfed. We have very much been looking forward to diving into the topic of M&A today, where we have two experts with us today. We have Graham Smith, who is an M&A advisor and has good experience on that side of the table, and then Rustin Toms as co-founder of Blue Apple, who has also been through the M&A and his journey. And today we'll really dive into M&A from both sides of the table and what it's like in the contract catering world. Also, where we in the recent time have seen a boost in M&A activity, also highlighted by the acquisition of Fermat 1 month ago for 1.5 billion euros, one of the largest exits in this industry ever. So it's really a relevant time to dive into this topic. But to kickstart the conversation, I would love to actually just do a quick round of introductions for the participants here today, but maybe starting with you, Graham.
Peter, thank you so much for inviting me onto this podcast and to a topic that's very dear to my heart. So I'm a corporate finance specialist here at Alex Partners, and Alex Partners is a global management consulting and advisory firm. So I've been focusing on providing a fundraising and refinancing advice across travel, hospitality, and leisure now for over 20 years. And in the last decade or so, I've had a particular focus on the contract catering industry. And I've been really fortunate to work with some fantastic businesses and founders, helping them sell their businesses, including the likes of the Brookwood Partnership, Harper& and Jones, Vacheron, Pabulum, and most recently, a Genuine Dining Company. Great businesses, typically founder-led businesses. And in addition to that, also being fortunate enough to work with some of the large groups as well when considering acquisitions in the sector. So, delighted to be speaking to you today.
Very nice. And maybe then over to you, Rustin.
Hi, yes, thank you as well for inviting me to join your podcast today. Yeah, my name is Rustin Toms, founding director of Blue Apple, and recently sold the business. My career started in the kitchen. I was a trained chef, and then I went into catering management, which was quite varied, from Terminal 4 at Heathrow to hospitality at Wimbledon, and then into general sort of what you would call B&I contract catering, and then left and started my own business, Blue Apple, with my business partner in 1998.
Very nice. I think it would be a good start to actually dive a little bit more into the journey of Blue Apple. Would love to hear a little bit more about why did you start the business, and also what do you see as the reason why it has succeeded so well in the market?
Yeah, sure. I think I always had that sort of entrepreneurial itch within me. I'd worked for large organizations. The last organization I was working for was a rent-to-kill initial business, and that was with Initial Catering, which I think is now branded as Autograph. And I think it was, the contract catering is a relationship business. It's very, client driven. I always felt that, I could do it better. I just felt that sometimes we were constrained by corporate bureaucracy a lot of the time, and inflexibility. And I think the good sort of independent contract caterers are the ones that do flex and, tailor the service, to the client. And that just becomes harder by scale. So I think, the companies that Graham's just, referred to, you sort of reach critical mass, maybe 100 clients, where the proprietors of the business sort of cease to be able to give the close attention. So I was working for a large contract caterer. I felt it was a bit, I always say, catering by numbers, and, the company wasn't innovating, enough. And sometimes I would sit in sales presentations, and what I was selling wasn't necessarily being translated, or got lost in translation when it was handed over to operators and began operating. So I think it just gave me the confidence, that we could do this better. I was 34, relatively young, started the business with a business partner, Brian Allenson. I think you often see that in our sector. There's usually pairs of founders who work together, who have opposing skills, different skills, but collectively they make a really, strong team. Also, I think it's relatively easy to start a contract catering business. You can start it from your front room, which is what we did. And you just have to, start modestly. And we borrowed a small amount from NatWest Bank to get some working capital together. And then it is a question of just, getting that first client and the next client. And I think if you asked about the success of Blue Apple, I think over the course of the 26 odd years that we had the business, we were always tempted to borrow to grow the business, but we didn't do that. So we didn't become a heavily geared business. And because then I find that you're working for whoever the investors are or the bank. And so we always reinvested in the business. We were, quite modest about, the dividends that we paid shareholders, and we grew slowly but steadily. The other reason I think for our success is we were quite selective over about the clients that we worked with, and the geography of our business as well. Because again, I think you can start chasing growth by going all around the country, but then it's not sustainable and you can't support it operationally. So we were always quite strict about the geography of where we worked and the types of clients that we worked with. So we purely targeted business and industry and clients, I think, who valued a food service operation to their employees as a worthwhile sort of company benefit, rather than clients that sort of did it because they felt they had to. So we weren't necessarily the cheapest contract caterer out there. There are even a few stories where we lost contracts on price. The client changed, but then came back to us a couple of years later. So we likened ourselves to a sort of, boutique-y business on a par with, if you were to liken it to a car brand like an Audi or BMW. And so I think it was just about good, strong, close relationships. All of the senior management team had great longevity with the business as well. So the relationships they built up with clients stayed, for many, many years.
And when you were sitting at the corporate prior to founding Blue Apple, and you were saying like you felt that you could do better if you were independent and not like limited by a corporate in that regard, like was that specific areas of the operation where you're like the food, the service, what was the point where you're like, okay, I can really see this could be, if there was my business, I would have done this differently?
Yeah, I can tell you exactly where it is. And it's the very contentious area of purchasing. And I think, many of our clients, as part of their sort of corporate social responsibility policies, like to support the local economy. So we were always very flexible in using local suppliers within maybe a 25-mile radius of our clients. It's perhaps, not from our point of view, the most cost-efficient way of managing your supply chain, but it won us business because we said, yes, we can use the local dairy. Yes, we can use the local grocer. Yes, we can use, the local butcher. And then some of those business grew with us as well. There were, some of them were small, family businesses. There's a very well-known, famous bakers in Hertfordshire called Simmons, a great business, but they only have shops in Hertfordshire, and they're a really good, I'd liken them to a sort of premium Greggs, if you know what I mean. But they sort of grew with us. So I remember we started using them at EasyJet. So when we pitched to EasyJet, we said we can use a Hertfordshire-based bakery to supply all your bread and cake and bakery products, and they loved it. So I think the larger food service businesses have to consolidate their supply chain, and so they were very inflexible. So in our pitches, as well as we're great people to do business with, we provide excellent food, but that's a given anyway. We'll flex our supply chain, to accommodate your business objectives.
And at what point during the journey did you then start thinking about that this was a business that down the line potentially could make sense to sell? And then, of course, prior to the exit to CH&Co and so on?
It probably was a good 10 years, I think, before, because there were some ups and downs. Started in 1998. We made a small acquisition of a distress sale in 2010 of a company called Zest, which took us sort of into the Midlands. And then we thought we could, scale this. I think my business partner and I, we were having too much fun, and we never really thought about exit for quite a long time. we were enjoying what we're doing. And I think that's part of it. It's almost, it happens by stealth. If you're running a good business, you're enjoying it, and you think, well, actually, this business has got some value in it now, surprisingly. And so then we started to focus on, the EBITDA figure and the multiples, which I'm sure Graham might allude to, later. And then, I think we were, as I said, we were quite selective about clients. So if there are any, at that time, there was a penchant for fixed price contracts, which are quite tough to run, because if you fix the price and you get it wrong, you're likely to lose money on the business. And then COVID changed all that. So caterers were not willing to take the risk of fixed price contracts. So it reverted back to cost plus. But now I think that's changing again, because the landscape's different, and clients are pushing for cost plus. So, I think, I saw other peers growing and, selling their business. I think it also comes down to age. You think, okay, when can I keep going at this pace all my life? I'm 62 now. Still got a lot of ideas and passion inside me, but we felt that maybe coming out of COVID, we came out quite strong, and we had a week in I think it was November 22, and we had 3 people approach us in the same week, which was bizarre. And previous years we'd had a couple of false starts, because my business partner and I, although we were both trained chefs, we're craft-based background, then you learn how to run a business, and then you have to learn how to sell your business. I did have some conversations with Graham, and he was extremely knowledgeable and had great experience in M&A activity in our sector. And you learn how to structure your business then, to make it attractive to other investors.
Yeah, I think that's a really good bridge over maybe to you, Graham, because now, of course, Rustin has been a part of both selling to CH&Co in 2023, and also indirectly a part of the big exit of CH&Co for 475 million pounds to Compass Group. I think that's also asked the question, like, why are we seeing so much M&A activity in this industry? And also, do you expect it to continue, and how do you expect it to develop?
Yeah, actually, this industry has been a pretty consistent performer when it comes to M&A activity. One of the things that we've seen post pandemic actually was a differential in performance between what we would see as the contract catering world and the sort of high street restaurant world. And you only have to look at the share price of a business like Compass and compare that to the share price of some of the listed restaurant businesses to see that divergence. Compass has performed incredibly strongly. And I think what's really driven that is, this sense that, caterers are an important partner to businesses, to companies, to healthcare providers, education providers, who, when those businesses have been faced with challenges of bringing people back to the office, of dealing with food price inflation, with supply chain disruption, the caterers have absolutely been experts in those areas. And when it comes to business and industry, playing an integral part of being the attraction of getting people back to the office. So from a revenue perspective, a profitability perspective, the protection that contract structures like cost plus contracts, which Rustin's mentioned, the protection that they provide the caterer from things like inflation, that, compared to when you've got a menu that you're selling to customers on a high street, the price is the price. You can, flex it from time to time. But when you've got that partnership style relationship with the clients, then that is a very sustainable model from the perspective of the caterer. So I think that growth and the profit performance has been incredibly strong, and I think that's given confidence to strategic buyers and also to private equity to continue to invest in the sector. I think what we've also seen is that M&A as a strategy for businesses to grow has proven to be very successful. There are sort of many tales and studies of whether deals actually drive shareholder value. But I think actually in contract catering in particular, they've tended to go very well. CH&Co is a great example of that, how, Bill built that business up through a number of different mergers in the industry to create this sizable player, grew that significantly to the point where he's able to secure the exit to Compass. And I think a lot of that comes down to integration as one of the areas which can often cause deals to fail. And a huge part of a successful integration is all about people and culture. And actually, if you think about what a catering business does, a core part of its business is being able to onboard new contracts. So they win a big new contract, and all the staff at the client on one day work for one business, the next day they work for a new business, and the caterer who's won the contract has to come in and onboard all these new people, get them to understand what their business is all about, how they treat them, and ensure that continuity. And in some ways, an M&A deal is just onboarding a whole load of new client business all at once.
Yeah.
And so I think actually the sort of the muscle memory of how you maintain culture and ensure continuity and make sure that integration goes well, a little bit comes second nature to caterers. And I think that's a really important part of why A has proven to be a successful strategy for growth.
I think that's super, super interesting. I also think an interesting piece of this is also related to a little bit actually what you touched upon, Rustin, but we have over the last few years seen a bigger consolidation of the industry. I saw like in last year, the largest 4 caterers in the world in average grew about 10%, while the market as a whole only grew about 5%. Also, of course, making them fill a larger part of the total pie of the contract catering market. But I'm also curious on how do you potentially see that going in the future, both of you, and also what you mentioned in the beginning, Rustin, about also being able to tailor the service for the client. And is there going to be a new bunch of independents that's going to come up and break through, or how do you see this playing out over time?
Yeah, absolutely. As Graham will have identified, it goes in cycles, and there are startups now. I can think of 4 or 5 who are, following the same journey that I did, and as the sort of global economic market is still in turmoil. There's pressure on business and industry businesses, left, right, and centre. And having something very simple like a really nice subsidised workplace food service operation is a great, morale booster for your employees and business. And there have been studies done, I think, at Stanford University where, the collaborative element of having a space where people talk and interact, which can happen in a staff restaurant or cafe, really helps a business. It's a very intangible thing, and quite difficult to measure. But there are, businesses who are guilty maybe of working, the employees are working in silos and they're not cross-fertilizing and sharing ideas. That's probably exacerbated by home working. And there are many, big organizations now who are trying to discourage home working because they realize it's perhaps not the best way for people to work. So a good food service operator can sell that to the client and say, look, we're not just a catering company. We can actually add value to your business by creating this space. And that was the other, I think, if there is a USP that Blue Apple had, was we placed quite a lot of emphasis on the design of the environment that people are eating, relaxing in, to encourage them to go in there. So it was really important to have booths, for example, where people could maybe have a meeting with 2 or 3 people, have simple things like USB-C, ports for them to plug in their laptop. And I think the more enlightened clients do that, they make it a working space as well as a space that's not used just between 12 and 2 at lunchtimes. So that will continue. So I think the requirement for small independents to provide that, unique, bespoke, tailored eating, drinking, working space will carry on. And there'll be lots of M&A opportunities for Graham in the future, I'm sure.
I'm really curious, and yeah, how you see that, Graham. Also, like, do you feel like is it starting to become a risk for like the likes of Compass Group, Sodexo, Aramark, etc., that they are having so dominant position, and maybe the clients at some point don't want to use one of their 15 sub brands. They maybe want the new one that can source locally or whatever the different advantages are. Or how do you where do you feel like we are in the cycle of this, so to speak?
Yeah, I think in the end, clients quite often want to see a mix of caterers on the tender list. You know, they want to see what is the proposition from the largest, most well-established businesses in the market, but they're also interested to see what smaller independent players can offer them. You know, to a degree, it comes down to what's most important to the client. So I think that desire to see a mix of propositions on these tender lists continues to make a fertile ground for new growing independent businesses to establish themselves in the market. Because you're right, there has been significant consolidation, and the largest groups very much have this sort of house of brands where they can talk to their clients and figure out exactly what they want, and therefore line them up with their right brand to meet that need. But there's always a space for the good, successful, independent player to provide that alternative, because that's absolutely what some clients want. So they can always get that visibility and that opportunity to show what they can do. What I would say is that it does seem to be a little tougher to start up now than perhaps it was, say, 15 years ago. I think the points around sort of risk and compliance and procurement rules and regulations, there's probably more hurdles now for smaller players to get over in order to get onto those tender lists in the first place. But I think if providers can get over those hurdles and get onto the list and get the chance to show what they can do, then I think there's good white space for them to grow into now on the back of what has been a period of consolidation.
Yeah, very nice. Then maybe if we dive into actually like the whole process of this, I'm curious, we already touched very briefly upon it, but like if you are in Rust and Shoes or in any other country caterer's booth, and you kind of start to say, okay, we're getting towards the end of my journey here at the company, how do you start to prepare a country catering company for an exit? What do acquirers look at, and how do you do that whole process from both of you?
So when I think of the advice that we give to potential clients who are thinking about this, then the first thing we always say is that the most important thing is to continue running your business on a business as usual basis, because it is quite an uncertain outcome. There are some things which are in your control, but there are many things which are out with your control. So to pin all of your hopes on an M&A exit as the way for you to deliver value and protect value for yourself is very much a high risk strategy. So focusing on running the business in the right way for the long term is the most important thing that we say right up front with clients. Then once we talk about that, and it's really about how is the business going to grow. The most attractive thing for a buyer when looking at business is one that is growing. It's got a track record of growth. It has plenty of prospects to keep growing. So that's absolutely fundamental. So, run the business in the right way, focus on growth. Then there's a lot of things that you can do in the background just to make sure things are tidied up. All your client contracts are signed, your books and records are in good order, accounts and tax are all up to date and filed on time. Really, quite tedious, boring things like that. But it's important just that, all of those sort of, loose ends are really tidied up and in good order. And then particularly if you're a founder and are thinking about an exit, then it's really important to have a strong team around you, because there's nothing that sort of concerns a buyer more than if there's a business where there's one individual who is absolutely critical, because if that's the case, they worry very much about longevity and the ability to continue to grow the business in the future if that individual isn't around. So very much sort of focus on that team and make a little bit make the team the star, actually. And then also try and kind of step back and think about, what is it that makes your business special? What is it that enables it to win and be successful in the market and to grow and to keep clients happy? Why do clients choose you, and why is that resilient? And again, a little bit with contract caterers, what I've found is this element of it, also a little bit like the integration, comes reasonably naturally to them because of the fact the tender processes they have to go through to win new work are incredibly rigorous and time consuming and highly competitive. So that ability to articulate quite clearly what makes their business special is something that they're used to doing and telling to clients all the time. So just reflecting on that and, making sure that still stands, and that's still at the heart of the business, then, that's really important, because that's, in the end, can get the buyer excited about what will it be buying. It's not just the contracts, the revenue, the profit, the team. It's owning something that has something special in the market that it itself doesn't already have.
Makes super good sense. What about you, Rustin? What was your experience of that process, also of preparation and so on? And maybe also when you started the journey, how did you also approach it? And you, Graham, how do you recommend people to approach it? Are you talking with multiple buyers, or how do you actually tackle that situation?
Yeah, I think first and foremost, it takes a long time. So there is a extraordinary amount of due diligence, takes place, quite rightly, because I always think it's actually quite risky buying a service-based business because there are no assets. So as Graham alluded to, the relationships, the strength of the senior management team and the relationships they have with the clients, so important. We, for the shareholders, having a little bit of competition in the process is quite useful. So we, as I said, we did have multiple approaches. One dropped out fairly quickly, and then there were two. So that helps perhaps gaining a premium for the business. And then again, as Graham said, keeping your eye on the ball through the process, because it's very easy to lose sight of the day-to-day operations. I think because the due diligence process is so drawn out and complicated, and for a small business is a huge drain on our resources gathering all this information. So you need to really concentrate on keeping your teams and your clients happy. And then the other thing that we did was we incentivized the senior management team. So they did have some minority shares, and we were very clear from them when we sort of said that we tried to be as least secretive as possible with them and not treat them like fools. I think we explained that exit was on the cards, and so we would like for you to benefit from this. Otherwise, I think founders of businesses can be accused of, not working very hard, but gaining all the benefits. So we wanted the whole of the senior management team, many of whom had worked for us for 10 years plus. So they deserved that as well, and they then were interested in making sure that the business stayed on track during the due diligence process. And then the earn-out phase. So, typically in these deals, there'll be an earn-out of 1 or 2 years to retain the business, and the final consideration is based on that. Yeah, I think, initially our attraction to CH&Co was this house of brands that Bill and Tim were building. We felt that we could coexist alongside the likes of Vacheron and Company of Cooks and Gather and Gather. As we were already competing against these companies anyway, but it was amazing how, little we maybe cross paths. We could still tender and grow our business without directly competing with some of these brands. So we felt that was a good fit. And also, going back further, when we started the business, I always feel that everybody needs a mentor, someone to guide them and show them. And my mentor was the late, great Robin Jones, whose husband, Tim Jones, then became, chairman of CH and Go. And, in a way, Blue Apple was modelled on CH and Co because of Robin's indirect influence. I would meet with Robin maybe once a quarter for lunch, and I would pick her brains and I say, Robin, how do we do this? How do we do that? We've got this problem, how do we solve it? And she just did it out of the kindness of her heart. I think she quite, liked to see successful businesses grow. And I did it also to a lesser extent with another late great person, William Baxter, who was also very supportive. Whenever I saw him, a couple of golf sessions with him, he was always very sort of hand over your shoulder and was quite happy to give his advice. So that's why I think when eventually we did do a deal with CH and Co, it sort of felt right to me. It was almost our destiny, to do that.
It's always great when you kind of can find a new home for the business and what you have worked so hard for.
That's right, yeah.
Maybe also over to you, Graham. I'm curious on both like advices during that process, but also how do you actually value these businesses? Is it based on like EBITDA? Is it based on revenue? Like how, if you are advising acquirers or sellers for that matter, on what is my business worth? How do I value it? How do I look at that? How would you normally like advise them and go about that question?
That's one for Graham.
So, no, I think first of all, the point around making sure that there's competition, I think that is important, just to make sure that buyers feel as though they need to, if they make a proposal, they need to either stick to that or improve it, because the risk is if they don't, they're going to miss out. And that doesn't have to be another buyer. That can be the fact that the seller is more than willing to carry on with the business and not sell. We certainly have that in some of the engagements that we've worked on where there has been a single acquirer, but really the threat to them being successful in buying the business was the fact that there wouldn't be a sale at all. So I think having that credit threat and competition and pressure is really important, just to make sure you get the best price and the best terms. In terms of how businesses in this industry are valued, then in my experience, the focus very much is around EBITDA as a profit measure. That's your profit before interest, tax, depreciation, amortization, trying to get a sense of what is the sort of the cash profit before capex that the business is making, and looking at a multiple of that. And that multiple will be driven by many things, quite often around the growth track record, the growth prospects, the strength of the brand in the market, and also the synergies that a buyer can expect to generate from a deal, either through revenues or through cost savings. And quite typically, you can look at a multiple of around about 8 times as a baseline, and then flex either side of that. Certainly, a number of the deals that I've worked on have, got up into double-digit EBITDA multiples, but very much in those cases where the growth is really strong, the brand is strong, and there's a really strong strategic fit with the buyer. So that's generally how we look at it, and it's important, therefore, to have a well-considered business plan, which not only tells a story of how a business has got to where it is today, but also how it will grow in the future, and also think quite carefully about what it is that business can do for the buyer. What is the strategic gap that it can fill? What is the ability for it to bring benefits to perhaps existing contracts that the buyer has, where the proposition that the target has is perhaps at a higher level than the existing ones that the buyer has. So there's some further upside from that.
Yeah, well, that makes great sense. And then I think if we look at now after the acquisition and so on, of course, we want to integrate into the acquirer's business in various ways, depending on the acquirer and so on. Like, I'm curious, and from both sides, hearing like how do you advise and how do you deal with that? Anything from informing employees to customers, and I would also assume that it changes things in a business, both for being an employee, for being going from being the founder and owner to now being a part of the bigger corporation. How do you see what are the key to post sales integration making that successful?
Shall I go first on that? I think, I mean, again, as Graham said earlier, contract catering businesses are quite used to that process because of the integration of new clients and onboarding new clients and staff when you win new business. So it's that, but bigger, really. I think you have to allocate a dedicated team, though, to do it. So, yeah, it has to be quite sophisticated. I think the messaging has to be very timely and clear, because I think in these situations, rumors start and misinformation, people don't hear information, so they fill in the gaps for themselves, which is invariably wrong. So I think you just have to keep the communication going regularly to satisfy people's curiosity with what's happening with the business and where it's going. And that's both client facing and employee facing. It's both sides that needs to happen. And I think rewinding slightly, as part of the preparation for exiting or selling the business, the founders, I think, should be taking a little bit of a backward step, because there probably will become a time where they're not in the business. So that, I think, dovetails in nicely to the senior management team having a stake in the success of the business, both whilst it's operating and then at the point of exit, because they're probably more likely to be still in the business. And as Graham said, I think a potential acquirer will look at the strength and skills of the senior, management team. So I think the founders of the business should be, I mean, someone once told me the art of management is making yourself redundant so that you become the grand conductor. So I think, at the point of exit, the founders should be important in that they still have, strong client relationships and employee relationships, but the business isn't dependent, or the success of the business and the financial success of the business isn't dependent on that. But the other key box to tick is the IT integration. That's so hard these days because everyone's got, slightly different systems, and that takes a huge amount of effort to get right. You're having to retrain employees on their catering management system, which they'll be using at, unit level. So lots of training and development. And we did like a buddy system whereby you would have groups of contracts, maybe 3 or 4, and you'd have one lead contract that the other contracts could go to. So the manager there would act as like a help desk to the other units who were much smaller and maybe didn't have as many staff, because sometimes trying to get through to a helpline or raising a ticket. IT helplines have a ticket, which you raise a ticket, but then you might not get a reply for 24 hours, and even 24 hours is a long time when you're trying to order food for the following week, So yeah, I mean, it's not without its challenges, but it's just a question of organization and throwing resources at it.
Yeah. Do you have any thoughts on that, Graham, from your side? Do you also normally stay involved during the post-integration? Do you normally leave it there? And yeah, what are some of the things you have seen, and have you maybe seen it go also terribly wrong? Or how do you normally see this play out in this industry?
So as a firm, we actually do a lot of post-merger integration support on deals. Now, I think what we certainly seen in this industry is buyers have become much more sophisticated at this process. I think cast your mind back 15 years ago, and a little bit the sense was, well, make the acquisition day one, everything goes onto buyer's systems, all the procurement switches, just absorb into the buyer and how the buyer does things. I think, nowadays buyers are really looking at, again, going back to that point, what is it that makes the target special? What is it that makes it different? Go to great lengths to preserve that. So really the message for clients is, again, day one, business as usual. Nothing's changing. You'll see the same people on site, the same people in the kitchens. buying from the same places, don't worry. Everything will carry on. You're not going to notice any immediate difference. And then slowly go through that process of maybe the switch over onto sort of IT systems, onto, certain procurement lines will be switched because it kind of makes sense. And actually, it does save money and there's no difference in quality of what's provided to the customer. And so I think that the effort to make sure that, clients and team members feel as though, it's very much, business as usual, same as it was. And, Rustin's right. Just over communicate, because in the absence of communication, people do fill the gaps, and they don't tend to fill the gaps with very optimistic things. They can worry a great deal about what's going on behind the scenes. So I think,
people don't like change, full stop, do they? So
no, that's right. And people tend to assume the worst rather than the best. So make sure you've got a communication plan. That's all ironed out in advance and ready to go, and then delivered consistently post acquisition.
That sounds super great. I think here to round it off, the last 3 minutes, we'll just do a few quick questions, and if you can just answer as short as possible, and then we'll end it off here. So I have one for you first, Rustin. What do you see like the biggest changes that your employees have experienced going from being independent to CH&Co to now being Compass Group?
Career opportunity and progression is much better being part of a bigger group.
Amazing.
Would be my quick answer to that.
Yeah, that's great. Maybe also you then, Graham, do you see that there will be more or less M&A in the future if you were to take a stance on that?
So I think it'll continue at a pretty similar level. Actually, I think, as I say, helpfully, deals that have been done have gone well. There's a lot of competition in the market, but people are tending to trade very well in the market at the moment, and there's a reasonably high degree of confidence around that. Yeah, I'm pretty confident that it's going to be a continuation of the current trend.
That's great. Then over to you, Rustin. If there was one question that you wish more buyers would ask you as a seller, what would that then be?
I mean, it sounds obvious, but yeah, why is your business successful? Sometimes that's not articulated. It tends to focus on just the finances. And yeah, what is your USP? I'm quite famous for saying there's no USPs in contract catering because it always has the same staff pool, same supply chain, and everything. What makes the difference? I mean, generally, I think the answer to that is the people, but sometimes buyers don't really drill into that and find that out. Everything gets consumed by the deal.
Yeah.
If that makes sense.
Yeah, it definitely does. And then a very large one before we round off is for you, Graham. How large do you feel that a contract catering business should be before they both make sense to sell, but also before they start being attractive for acquirers?
Good question.
Yeah, so it seems to be that once a business gets over about £30 million of annual revenues, that it starts to get towards a size where some of the bigger players will see it worth their while to invest the time to kind of get to know a business and see if it is a potential for an M&A deal. And I'm not sure of the psychology or the financial rationale for it, but it does seem to be quite a clear threshold that businesses need to get over.
Yeah, I would agree. Yeah.
Amazing. Thanks a lot, both of you, for taking the time here to participate. Really, really appreciate it. And a lot of great insights. So it's been amazing having you. So yeah, thank you.
Thank you.
Yeah, it's been a pleasure. Thanks, Peter.